A very warm welcome to the Risk Reversal Podcast. You know my voice. I'm Guy Adami. You know her face, soon to know her voice. Of course, that's Elizabeth Thomas of SoFi. Hello there.
Hello. Also a proud Packer fan today. I was really
Well, thank
nervous
you.
for a minute that the Giants were going to actually pull ahead in that one,
No,
and they
you
were
were
ahead
never
for
nervous.
a
You were
hot
never.
minute.
Well, listen, as a fan of the National Football League, as you are, I don't think there's any team out there right now that does not find themselves, or fan base that doesn't find themselves nervous at some point. But I think we both knew or know that the Packers were going to overtake the Giants, who are now
Well,
a robust 2-9.
there are a couple games this year that I thought I knew the Packers were supposed to overtake, and they didn't. But anyway, let's talk about markets because I'm happy. I'm happy that we got the W.
No, yes, I am as well, because at this point, unless you're winning, you're losing, and better in the
That's
NFL to
right.
lose and, yeah, be one of those teams that are going to pick high in the draft. Although I will say it
True.
hasn't helped the Giants all that much. With all that said, let's start with one of your oldies and goodies, relationship problems. And people are like,
Ah,
why are you starting there? Well, we're seeing Japanese yields across the board at either multi-decade highs or in some cases all-time highs, in addition to seeing a yen that continues to weaken against the dollar as we're sitting here today north of 155. And people say, well, why? Well, because I do think it's important. And we've seen before that there are not trickle down effects. There are significant effects in terms of global equities. And I'm not saying we're at the precipice, but this is something we have to watch.
it absolutely is. And relationship problems, for anybody who's not familiar, are what I call the relationships within two variables in markets that aren't acting like you would expect them to act. And I talk about them a lot because typically when you see a relationship problem, they don't last forever. So at some point, you have to expect that the relationship goes back to its typical behavior. So when you have this sort of departure from the norm, you have to wonder which one of these variables needs to move in the opposite direction. The question today about why is it happening, I think the article that I saw that was maybe the most telling this morning was just about anticipating the next round or anticipating a large round of Japanese stimulus and some nervousness about how that was going to go. So stimulus, depending on what type and if it gets to the right places and if people use it the way that it's intended, all of that, it can be either detrimental or it can be beneficial. But I think there's some worry about whether or not this is going to work. And if you pump too much stimulus into the system, it can depreciate a currency. So we are looking at a depreciation in the Japanese yen. But at the same time, I don't know the stat, but there's something about the 20-year JGB hitting the highest level in however many years or whatever it was today. So those two variables moving in directions that we wouldn't expect. I think that there is less of an appetite, less confidence, we'll say, less confidence that the approach that's being taken is going to work, especially because Japan has been an economy that's just been in trouble for decades. And I think perhaps there's this belief that, well, it's been bad for so long. Is it going to suddenly get better just because of a stimulus package or because they abandoned the yield curve control? I don't know the answer to that, but it doesn't seem like investors have a whole lot of confidence in it right now.
No, and I'm trying to figure out like what it all means in terms of connecting the dots between our equity market, maybe more specifically, more granularly, our bond market. Again, it's not really showing any signs of, I hate the word contagion, but making its way here. But I think it's something you have to watch, which leads me to the next thing. Here we're sitting on a Monday afternoon, and the stock market is having a down day, but not anything abnormal. The S&P has been floating anywhere between down 0.5% to up small to down 0.5%. Dow Jones down 0.5%, Nasdaq down 0.5%. Maybe the Russell is the outlier, down 0.75%. I only mention that because we have a volatility index that is now north of 21. And again, I'll say this is not a abnormal day by any stretch, but you're seeing an abnormal move in the VIX. And I'm not asking you to trade VIX. I'm not asking people to trade the volatility index, but there's something happening with volatility on what historically have been somewhat benign days. Just thoughts on that.
Yeah, so the decline that we're seeing today is what I'd call orderly.
Yes.
It's nothing dramatic, right? It's nothing that anybody's going to freak out about and start selling all of their stocks or decide that their risk tolerance was too high just because of a 0.5% decline. But when you add a bunch of stuff together, there have been declines over the last week that have brought certain asset classes down. I mean, look at what's happening in Bitcoin right now. So there have been some declines that are a little bit more nerve wracking, much more large, particularly the stocks that have been the darlings or the ones that have run up so far and so fast have given back a big slug of that move recently, which is an unwind in beta, an unwind in momentum. And the stocks that have been driven by what we call multiple expansion give back that multiple expansion very, very fast. So I think right now what's happening, particularly with the VIX, is that you've got really strong selling pressure in certain spots of the market, the ones that had been very inflated. And then you've got a lot of other investors who really want this market to stay strong and trying to come in and support it through other ways, meaning other sectors are picking up the slack. Healthcare has seen such a big run in the last couple of weeks, and trying to see that the market can pull its weight from other places instead of just these momentum driven stocks. But that is driving a lot of choppiness. Not to mention, last week was a really busy week with the Fed job owners. There were a
Yes.
lot of Fed
Hmm.
speakers last week, and they scared the market quite a bit. We went from, I think, 65% odds of a cut in December, and now this morning, last time I checked, it was back down to like 40%. So that's not helping either. And that's going to drive volatility because this market has been clamoring for cuts for a long time. And now it's starting to have to digest the idea that we may not get them as fast and furious as we wanted.
Yeah, I'm glad you mentioned that because I was going to go there. 40%. We talked last week. I think we were both surprised at how precipitously that was dropping. Again, I want to be clear. I still think there's a rate cut in December. It doesn't mean I think there should be. It doesn't matter what I think, but I think there will be. But heaven forbid if there's not, because I don't think the market would obviously like that all that much. Although, at 40 something percent to a certain point, the market is preparing itself for that. But you also have an administration that I think is going to really push back if you don't get a cut in December and if you continue to hear things about affordability and all those things. So just sort of the rhetoric around the lack of a cut could be market moving as well. Again, not politically. I'm not talking politics. I'm just trying to figure out through the lens of the market, what might happen. Because I do think the noise around that could be market moving. Just thoughts on that.
Well, I mean, you mentioned affordability. Are you talking about housing affordability?
All across the board, affordability is a word that's being thrown around a lot over the last couple of weeks.
Yeah, well, I'll talk about just housing affordability and the desire for that to obviously increase. You want more people to be able to afford to buy houses and the housing market to become unlocked. And there's this general belief that if we get mortgage rates below certain levels, that suddenly all of these buyers will appear out of the woodwork, ready to shake their fists and buy these overpriced homes. So I
Hmm.
don't think that's going to happen. And the other thing is that everybody has to remember mortgage rates track the 10-year treasury yield
That's right.
closer than anything else. Okay. So this isn't that mortgage rates come down when the Fed cuts rates. We're looking at the 10-year treasury yield. And I do think that many people have expected, self included, that yields would slowly come down, but come down by more than they have so far due to rate cuts. That hasn't occurred. If you look at since September, since the September rate cut, yields have really not moved all that much. They're not in a place that I think the administration would like them to be, which means that mortgage rates have not come down to a place that many people probably would prefer they be. And if we're looking at just the different mental milestones, some people will say, well, if we get mortgage rates below 6%, if we get them to 5%, it'll unlock the housing market. In order to get mortgage rates down to 5%, the 10-year is going to have to move down a lot.
A
And if the
lot.
10-year is responding to growth concerns or labor market weakness to a point that it's moving down enough to get mortgage rates down to 5, then we're probably not in a great situation economically. So this is, you say this all the time, be careful what you wish for. In order to get mortgage rates down to that level with a quickness, I don't think it's going to be for good
No,
reasons.
I'm glad you mentioned that because I do think there's this misguided belief. Again, we've talked about this at length, but that the Fed somehow controls the bond market. They control the front end. We've said it along. By the way, more and more people are coming to that realization. They should have known it all along, quite frankly. But you have this stubborn 10-year, which, by the way, not that anybody particularly cares, I still think is going higher for a vast array of reasons. But if you were to see the 10-year go lower, my instinct suggests exactly what you just said. It's probably going lower because there's some sort of growth scare, and nobody wants a growth scare. So if you be careful what you wish for, because if you get those mortgage rates down to levels that will be appealing to people, it's probably because something broke along the way. I think we're going to get, and please correct me if I'm wrong, I think we're going to get a non-farm payrolls on Thursday of this week.
The
for
20th.
September. Is that right? So
That's correct. Yes.
What do you think? I think the consensus is for up 50,000 jobs. Again, I don't know how to read this at all, but the importance of that as we're starting to get back some data.
Yeah, I mean, it's important-ish because it's now at this point it's so dated. And we know that we're not going to get October data. So we're going to have to look back at, okay, how should have the market responded had we received this data on whatever the date would have been, October 3rd or something like that. Well, now we're going to be almost to the end of November by the time we find out what happened in September. I don't know that it's going to have that much of an impact at all. And at that point, too, looking backward, I mean, the reason that we're so obsessed with labor data, or that we were before, was because we're trying to predict what the Fed might do, or at least trying to prove to ourselves, meaning the market as us, trying to prove to ourselves that the Fed should continue cutting rates. So the market has wanted perhaps labor data to be weak enough that would support further cuts from the Fed. Well, if we're getting September data, we've already heard from the Fed again since then. And chances are they had a decent idea of what some of that data looked like anyway. They mosaic theoried it together with some of the other information. So it probably doesn't change much about what they said in October as it is. So I don't think that this is going to be that big of a deal, at least not this release. The fact that we don't have October's data and we are not likely to get October's data is an issue in transparency. And now I think I've mentioned this before last week. By the time the next Fed meeting happens, there will be a blackout period of Fed speakers. And in that blackout period, we're going to get November jobless data and we're going to get CPI. And that is really important to setting the expectations for what this next cut looks like. But I do not think this September data is going to make a difference.
So just hypothetically, I think unemployment rate expected to stay at 4.3%. If we were to get an uptick to 4.4, and again, I'm not suggesting we will, but will that be championed by the market because that 40% probability will then get ratcheted up in a meaningful way in terms of Fed rate cuts? So will that potential negative be a positive for the market, in your opinion?
Yeah, I mean, yes, I guess if we're saying it's positive that the market thinks that more rate cuts are coming, yes, that would be a positive, I suppose. And to the extent that this recent sell-off has been driven by the expectation of a cut coming down,
Right.
then maybe you see a little rally back up in it. But when you look at just what the Fed even expects for the unemployment rate by the end of the year, that's what they're expecting. So if it was 4.4% in September, they're expecting 4.5% by the end of the year. Still doesn't really send us that much further off track than
Right.
what they already think, right? So we've seen this before where you have this nervousness that comes in because the expectation of cuts changes. And then when that retreats because maybe we put the expectation back on, we have this rally. But do you really call it a rally when it's just back to where it was a few weeks prior? You can't really call it a rally. It's just kind of a round trip of, okay, we had a moment, we had a little tantrum, and now here we are as if nothing ever happened.
On Friday, and I want to try to do these in order. At 9:45, we get PMI for manufacturing. It's a preliminary number, and we get for November, I guess, and we get PMI services, which is a preliminary number as well. I mention that because I think you have agreed with me in the past, and I'm curious your thoughts. I believe that manufacturing is a tell on the economy. I believe that services is a tell on inflation. And again, I'm not suggesting I'm right, but the importance of both those this coming Friday.
So the most recent ISM survey readings for ISM services, ISM manufacturing, the prices paid component is what really flagged for a lot of people. Manufacturing prices paid were below expectations. Services prices paid were well above expectations and actually hit 70 for the first time in a long time. So that little piece, and then there's a chart that Mario put together for me with, it's got the ISM prices paid average, and then it's got all the regional Fed surveys prices paid average. And that would suggest that inflation pressure is still here, if not even building further. So those are definitely good reports to pay attention to. The argument that people might have on the other side of that is that manufacturing doesn't really represent the majority of our economy anymore, right? We're talking about hard goods. We're talking about the things that we represent in our minds traditionally as manufacturing, and perhaps our economy more driven by consumer, more driven by services, that manufacturing isn't as important. And the other argument being the economy's done just fine with manufacturing PMIs in contraction for a while because services have picked up the slack of that. So I think that's kept us afloat, but the inflation component of both is definitely something that continues to be a problem.
One of your favorites, Michigan consumer sentiment on Friday at 10 a.m. on the East Coast.
Michigan consumer sentiment, as a reminder, more skewed towards inflation than jobs. Conference Board skews toward jobs. So this is also a read on the consumer. The most recent data that we got was basically the consumer not being excited about current conditions. And I think that's representative of the fact that inflation just hasn't gone anywhere. And this is an anecdote that I'll point out. I have to give a presentation tomorrow, so that's on
Oh,
Tuesday. I gave a presentation to this same group roughly a year ago. And at that time, the name of the presentation was Stick the Landing. Okay.
ah,
So a year ago, the
with Kerry
presentation was named
Strug.
Stick the Landing. And I went back to see, all right, where were all these indicators at that time? Back then, so this was October 2024, CPI was at 2.4%. Today, CPI is at 3%. Not moving in the right direction. So back then I was saying, okay, you know what? So far we've stuck the landing, right? CPI is back down under a more manageable level. We as consumers are feeling better about this. But now here we are a year later. It's not a problem necessarily. It hasn't reheated to alarming levels, but from 2.4 back up to 3, we're not moving in the correct direction and the Fed is cutting rates. So that's another relationship problem. So this is something that I think we have to heed the warning of. And when you see these little pieces of data that are possibly driving prices higher, they can continue to drive prices even higher, especially if we're loosening liquidity conditions.
I mentioned Kerry Strug. You glossed over that. Of course, she famously stuck a landing at the Olympic Games with apparently
Ah,
a broken ankle.
yes.
Okay, yep, I guess. And then she was carried off the mat triumphantly by her coach Bella Caroli, I believe. For you gymnast fans out there,
You're
that's a
just a
great pull by
wealth of
me.
knowledge.
It is ridiculous, isn't it? Anyway,
Yes.
I'll move on to our final piece of this puzzle. You said it earlier, but I wanted to bring it up myself. Again, neither one of us, I think, would consider ourselves Bitcoin experts. However, there's no denying that Bitcoin, in terms of price action, has not been particularly robust since, I want to say, early October when it made its all time high. There's something going on here. I believe it's divorced itself from gold. I believe it's more of a risk on, risk off thing. And is this trying to tell a story in terms of some potential weakness in the broader market, specifically the Nasdaq? Thoughts on that?
So the most recent headline that I saw on it, I'm just going to read it very quickly. Bitcoin humbles Wall Street faithful after $600 billion plunge. This happened really, really fast. And over the weekend, Bitcoin had what's called a death cross, where the 50-day moving average moves below the 200-day moving average. It's not usually a good sign on a technical basis,
This sounds
but
bad.
it sounds bad. It sounds very bad, but trading far below where it was at its highs in October. So what's going on here? This is actually another chart that I have in an upcoming presentation, and it is under a section called relationship problems.
Of course it
So
is.
basically, we took the correlation of Bitcoin and gold, the correlation of Bitcoin and the dollar, and the correlation of Bitcoin and the NASDAQ, and found that currently, according to these studies, the correlation between Bitcoin and gold and the correlation between Bitcoin and the dollar, completely unreliable. You would think that it should be correlated somehow, right? Because that's been the premise of why people are buying an asset like this. Totally unreliable. Sometimes negative, sometimes positive, and honestly, mostly like 50-50. Right now, both of them are sort of skewing as a negative correlation, if not just sort of flat. But the most standout positive correlation is Bitcoin and the NASDAQ. So we're at a time where Bitcoin, I think, is responding to risk assets. We've seen a big let go, as we mentioned earlier, in a lot of these momentum trades. But Bitcoin is unwinding, I think, along with that, and perhaps for other reasons too that I don't understand, but it's not behaving the way that I think many thought it would. And it is pulling down the sentiment of the market.
Before we exit for the day, you had a great conversation on your podcast that I'd like you to share with the audience and let them know where they can find it.
Yeah, the most recent episode that I dropped was with Jenny Harrington. It was about her personal story. She's a pretty famous dividend investor. She's on CNBC with us all the time. So she did talk about dividend investing. But I think even more interesting was what got her to become a dividend investor in the first place. So a lot about her personal story and her background in investing. I thought it was great. It was one of the most favorite episodes I've ever recorded. And she and I had a great time doing it. And I hope that that comes through in the finished product.
It certainly did, having listened to it myself. And by the way, not one to listen to podcasts. I try to listen to as many of yours as possible. Anything fun you and Mario, I love just saying that, are working on this week?
We're going to start working on our outlook, our 2026 outlook. So that's coming early to mid-December.
Coming to a theater near you. I won't give you the website, but you folks know where to find it. By the way, in the new year, apparently, it's going to be SoFi.com, I think, /Liz, which is fantastic. I love that. As it always should have been, but that's just me. Liz Thomas, you're the best. She will be with us this week on the Market Call as usual, folks. Thanks for sticking around. We'll talk to you soon.